In this session, I'm going to look at the different payoffs that are associated with the derivative contract. Especially when I have bought a derivative, when would I typically make a profit? And what is the typical profit that I'm going to make? When and what? Similarly, when I am selling a derivative contract, when and how much is the typical profit or loss I'm going to make? That is what we are discussing about the payoffs, right? So we will be looking at the situations involving the forward contracts, the futures, and the options. For these three kinds of derivative securities, what are the kind of payoffs that are involved? In what cases we would make a profit? In what cases we would make a loss? How is the typical pricing for these things done? So these are some of the aspects that are discussed in it. So starting off with forward contracts, a few of the stuff which we have discussed even in our earlier session, wherein we know that the forward contract first of all is a derivative, which is a kind of an agreement between the two parties to buy or sell something, sell an asset at a future date and for the price that is decided as of today, as of the day of entry into the contract. And we know that forward is mostly is an over the counter contract, which means the negotiated price is existing between the buyer and the seller. So the buyer who wants to buy the asset at a future date, we call that he has taken a long position. The buyer we call as he has taken a long position on the asset. The sellers we call that they have taken a short position. So even in case of any kind of trading, long is generally used to describe the position taken by the buyer, and short is the position that is taken by the seller. And the most common type of forward contract that we see, which is having a heavy volume of trading, is on the foreign exchange currency. Currency forwards are the ones which are having the largest market, and they are very popular. Primary reason is, on one side you find that you find people using the foreign exchange forwards to hedge their currency exposure or a currency risk, whereas on the other side we see some specific set of individuals who want to take or get an exposure to different currencies across the world. So they are the takers of the risk based on the currency. What we see is a good number of investment banks across the world, or large banks. They do have a forex trading room. Every large bank has a forex trading room, and in that, as a part of that forex trading room, they have this forward desk where they quote the forward buy price, sell price, the spread that they have for forward buying and selling. And most of the time we see that the forward rates will be more or less closer to the spot rates, but small adjustment to the spot exchange rate, because there is an adjustment for the interest rate differential between the two countries. Interest rate differential between the two countries is what is reflected as a part of the forward rates. And what we typically see is, whenever I talk about a forward exchange rate, we take it as a spot rate, which is expressed in uh, per per one unit of the foreign currency. So probably I can say 60 Indian rupees per $1. So the spot rate is going to be 60. If I'm an Indian and I have the domestic rate, domestic currency is Indian rupee, then for 1 unit of a foreign currency, I'm talking about 60 units of the domestic currency. That is what I'm calling as the spot rate, and I will take it as I'll multiply it with the risk-free rate of interest in the foreign country, divided by the risk-free rate of return in the domestic. And the same thing if I am, sorry, this is the domestic, this is, yeah, domestic, and this is the foreign currency. So what we typically see is, even in case of the continuous compounded, I could typically see whatever is the spot rate multiplied by e to the power of r minus rf. R is the domestic currency, rf is the foreign currency risk-free rate of return. So the moment I see that if the domestic exchange rate is much higher compared to a foreign exchange rate, we see that the forward rate is going to be lesser than the spot rate. If the domestic exchange interest rate is much higher than the foreign interest rate, then we see that the forward rate is going to be much higher than the spot rate, going with any of this kind of a formula. Then generally, what we observe with respect to currency forwards is, let's say, me buying dollar with rupee should be same as first buying, let's say, a pound with a rupee and using the pounds to purchase dollars. So this is called as a multi-currency route or a cross-currency kind of a route. Even if I purchase a dollar through this route or through this route, both of them should cost me more or less the same, ignoring the transaction cost, which is a clear mention for me saying that the currency markets across the world are more or less efficient. Means the rate which I get through this should not be much different from the rate that I get through this approach. If they are very much different, probably people can create a kind of an arbitrage opportunity by executing the task in this particular manner. And as we already have seen, the forward contracts are typically used to hedge the currency risk. Just take an example. I'm an Indian, my currency is Indian rupee. I'm expecting some dollar payments to come to me. I've invested in US, so I'm expecting some dollar payments to come to me in Indian rupees. So for me, what is the risk? Now, if the Indian rupee is appreciating against the dollar, which means instead of 60 rupees per dollar, I would be getting only 55 rupees per dollar if the rupee is appreciating. If that's the case, I would be losing in my domestic currency. Then what I do is I'll sell a foreign currency forward, wherein I freeze the exchange rate to be 60 rupees a dollar. So I'm removing the kind of a depreciation that can occur with respect to the dollar. But at the same time, I have to understand that even if the foreign currency appreciates, which means my local currency depreciating also, I would not be able to take the profit out of it because I would still be receiving at 60 rupees a dollar. So I'm foregoing the profit that can come up. The profit potential is simply getting sacrificed. And what we also see as a disadvantage is the forward rates, whatever the bid and ask rates that are quoted by various dealers. What we see is the difference between the bid and the ask in the forward is higher compared to the same bid and the ask prices in the spot. So what we typically end up is, when we are going with a forward contract, there is a possibility that we are going to incur slightly higher cost compared to the transaction in case of a regular forward contract. So these are some of the a couple of reasons why we may not be looking at a forward contract on the exchange rate, but otherwise it is a very good hedge for the currency risk, and especially for an insurance kind of a company which has some kind of exposure to various currency risks, or any other business which has a lot of exposure to currency risk when it is expecting some kind of payments from abroad to manage the currency risk. There is some kind of this is some kind of a powerful tool which helps them in managing the risk quite effectively. Now let me start looking at the payoffs from the forward contract. So just to give you an idea, let's say today we have got into a forward contract, day 0. We are planning to buy or sell something at time period T in future, right, for a price K. So this K as a price is called as forward price, or even exercise price, or sometimes people call it delivery price also. So this is the price at which the buying or selling is going to happen at time period T. But this is agreed upon on day 0 itself, on the day we have got into the contract. And this particular time T, we call it as the maturity date, or some people call it as the expiry date of the forward contract, or the delivery date. And generally between the buyer and the seller, the forward price K is set in such a way that the value of the benefit, or the profit, the present value of the profit both to buyer and seller is 0. Because when it is clearly known that the buyer is not going to win, when it is known that the seller is not going to win, there is no point for them to enter into the contract. So generally what we talk of is the expected present value when I look at of the profit, when I look at it from the perspective of the buyer or a seller, is 0. Only after I enter into the contract, as the days pass, depending on how the market is moving, one party will have a positive value and the other party is going to have a negative value. And one more thing with respect to forward contract is, on day 0, it's only an agreement between the two parties. No money is exchanged between the two parties on day 0. It's only an agreement that I'll buy something from you at time T for price K, and I'll sell something to you on time T for price K. That's only an agreement. No movement of money between the buyer and the seller. So the as the days pass by, so probably once I reach here, depending on how the market price is changing, and depending on how it is with respect to the exercise price, the either the buyer or the long position will be gaining, or the short position will be gaining. So the profit or loss will come out only after the initiation of the contract, as the days pass by and by. So whenever we see that the market price of the security is greater than the delivery price, then probably the buyer is gaining, and when the market price of the security is less than the forward price, then it is the seller who is gaining from this contract. And of course, both of them are obligated in case of a forward. Both of them have to get into the contract mandatorily, and they have to adhere to the contract. So what we see is, if I am looking at a simple a payoff diagram from a long positions perspective, if the strike price is, if the market price is greater than this forward price, so wherever it is greater, his benefit is going to be ST minus K, otherwise it is going to be a loss, which means from a long forwards position, this is the payoff. At the market price ST, the price on at time T, at if it is equal to K, then there is no profit, no loss. If ST is greater than K, he is going to make a profit. ST is less than K, he is going to make a loss. Whereas exactly on the opposite side lies for a short forward, because the short is really going to gain if the market price is lesser than K. So as the market price goes lesser and lesser, it's going to be a gain to the short position, and as the market price goes higher and higher, it's going to be a loss to the short position. So whenever we are talking about the payoff, we are simply looking at the profit or loss one is going to make from the particular contract. So this is the payoff diagram for a long position, and exactly the mirror reflection across the x-axis is the profit position or a payoff position for a short position. Of course, let's try to understand. Here we did not consider any taxes on the gains or anything. We did not consider any kind of transaction costs, because these kind of things are intermediated and there are transaction costs that are involved. Any kind of intermediate income that is going to come, we have simply ignored. Probably if that asset is going to pay some kind of dividend between now and T, we have ignored that particular aspect. All these things, after I ignored, whatever the position that is coming out is reflecting these kind of numbers. Now, looking at the futures, there is nothing much to talk about once I understand the forwards, because behavior is more or less the same. The only difference between the forward and the futures, just to understand, is futures are traded more on the exchange and they are more and more standardized compared to forwards. And probably the clearing house plays a major role. It is guaranteeing the trades, and because of that it has reduced the possibilities of credit risk occurring. And of course, on the other side, we are also seeing that the delivery date, in case of forwards, the delivery date is negotiated between the two parties, whereas in case of futures, there is not one single delivery date. Probably it cannot be a customized delivery date. Probably what is specified is the month of delivery, and during that month, every exchange has its own mechanism in terms of deciding the date. In some cases, it could be a range of dates instead of a single date. In some cases, it could be the entire month. Especially in some kind of commodity contracts, we see that the entire month could be a delivery. And if it is an entire month kind of stuff, the short position will typically have a right to choose the actual delivery date. And when we are talking about the payoff diagrams, they are more or less similar to that of the forwards. The payoff diagrams are more or less similar to that of the forwards. Now, moving further into options, trying to understand the payoffs associated with them. As we have understood earlier, we see that this is the only kind of a derivative security where we find some of them trading over the exchange and some of them trading over the counter. Whereas the other three derivatives, forwards are only OTC, futures are only exchange, swaps are only OTC. But options, a few of them are OTC based options and a few of them are exchange traded. And whenever something is exchange traded, it is more and more standardized and it is more and more marketable and a lot of liquidity associated with it. Whereas the more it is OTC, all these issues do crop up, but more and more customized, negotiated, some other kinds of advantages do come up if it is an OTC kind of a transaction. And in case of options, what is typically negotiated between the parties is the premium and not the exercise price. The strike price is fixed. The strike price is fixed. It's the premium that gets negotiated as a part of the trade. And so we have already discussed what is a call option. It's a derivative security which gives the holder the right to buy in future, and if he wants to buy it from a seller or from the writer's perspective, he is obligated to sell. Similarly, whenever I talk about the put option, the holder of the put option is having the right to sell, and whenever he wants to sell, the writer of the put option, there is an obligation to buy for the decided price for the decided date, right? So there is an obligation in terms of the seller or the writer, whereas there is an option in terms of the buyer or the holder. And because of that, the holder pays a premium. The holder pays a premium to the writer for giving this option to exercise. And whatever we see that what should be the premium is decided by some kind of formula kind of an approach, because this is the premium that is typically quoted in the markets. And what we see is majority of the times this premium is determined through some kind of pricing formulas. There are a few pricing formulas like binomial tree kind of a formula or a Black-Scholes kind of option pricing formula, which will typically be used for pricing these kind of options. And of course, whatever is the price that is agreed for a future buy or sell, we call as exercise price, or sometimes we even call it as strike price. So the date on which the exercise happens is the strike date or the exercise date. And there is one more differentiation with respect to options depending on when an option can be exercised. A broad classification is American option versus European option. So in case of European option, the exercise happens only on the expiry date. Whereas in case of American, the exercise can happen any time up to the exercise date. Any time up to the expiration date, you can exercise the option, whereas in case of European options, you have to exercise them only on the expiration date. right? And what we see is many other complex options. See, here we are seeing there is only one day on which you can exercise. There is almost any day on which you can exercise. These are the two commonly traded options in the market. Whereas there are a few complex or probably what we call as exotic options which have different mechanisms. Probably there is a Bermudan option. On a Bermudan option, it's like something in between the American and the European. European only the expiry date. American any day up to the expiry date. Whereas in case of Bermudan, we have a few expiry dates. Not every day, but at the same time not just the last day. We have a few points in between, probably once in a week or some such kind of a setup where the exercise can be looked at. So these kind of options are typically called as exotic options, and what we see in case of exotic options is they can be exercised almost only on a few of these days, not on all the days, and majority of these exotic options are traded only over the counter. There is no exchange for these. Hardly we see American, I mean very frequently we see American options on the exchange, and on some exchanges we see European options, but other different types of options they are seen only over the counter. Now, whenever I am looking at the payoffs, we know that here we have four positions: long call, short call, long put, short put. So these are the four positions that are associated with the options. So any buying position is a long and any selling position is a short. And what we see is in case of long call, as the market price is greater than the strike price, he is going to exercise the option and get a benefit of the difference between the two, because he can buy it if the market price of a stock is greater than the strike price. The call option will give him a right to buy it at the strike price. So he'll buy it at the strike price, immediately sell it in the market at the market price, getting ST minus K. Whereas if I see that the stock price on that day is less than the strike price, he has the right to expire. So he is going to expire the option. So there is no transaction at that particular point. So there is no benefit or loss that he is going to get, because he is simply expiring the contract. So, but at the same time, he is going to make a premium payment P. So whatever is the profit that he has got, probably P is something that he has already incurred at the time of beginning of the contract itself. So this is what is going to be his overall profit position, and whatever is the payoff for long, exactly opposite is the payoff for short, because whatever is the profit that the long has got, it is the loss for the short and vice versa. So probably if ST is greater than K, in case of short call position, what I see is the long is going to exercise it, which means for the short it is going to be minus of ST minus K minus P, which is same as probably P plus K minus ST. And when I see that the stock price is lesser than the strike, because the long is not going to exercise it, the short is also not going to get anything, but he has already received the premium earlier, so it's going to be a benefit for him for the amount equal to P. So if I just look at this concept and try to draw a payoff diagram, as long as the strike price is K, any strike price lesser than K, there is a loss of premium, because is not going to exercise that particular option, and after that the exercise happens and the payoff goes more like this. So this goes more for a long call position, whereas the exactly opposite goes for a short call position. So this is a short call position and this is a long call position, right? Similarly, the same logic I can think of with respect to the long put and the short put. So whenever we are talking about a long put, if the stock price is greater than the strike price, the long in a put is giving him a right to sell it at K. If the market price is greater than the strike price, why will he sell it at K? He will sell it at the market price itself, which means he is going to expire the option, which means there is no payoff involved in it. But if the stock price is lesser than the strike price, the long is going to exercise the option. If he is going to exercise it, means he is going to sell it at K. So buy it in the market at ST, which is lesser than K, sell it in the market immediately, sell it at the strike price K, which means he can directly make a profit of K minus ST. But remember, because he is in a long position, he has already paid a premium to the short. So his payoff is going to be 0 minus P, which is minus P when we are talking of stock price greater than the strike price, K minus ST minus P when we are talking about K minus ST minus P when we are talking about the stock price being lesser than the strike price. Similarly, when I look at it from a short put position, it goes exactly the other way. Whatever is the payoff for the long, the opposite for that is going to be the payoff for the short. Stock price greater than the strike price, the opposite of minus P, which is the P going to come up. And similarly, if the stock price is lesser than the strike price, the opposite of K minus ST minus P, which is the P plus ST minus K, is going to be the payoff that is associated with the short put position. And whenever I'm using another word called terminal payoff, I'm not going to bother about the premium payment, because premium payment does not happen on the expiration date. It happens much before it. So a regular payoff with respect to a put option for a long put, if this is the strike price, like this and this. So as the stock price or a spot price is going lesser than the strike price, there is going to be a benefit. And as the stock price is going, as the strike price, as the stock price or the spot price is going more, it's going to be a benefit for the short put. So this is the payoff for the long put position. This is the payoff for the short put position. And whenever I am talking about the terminals, probably I am ignoring the premiums part, which means the short put is like this, the long put is like this. So similarly, the long call is like this, the short call is like this. Because here we are ignoring the premiums that have been paid much earlier, right? So these are some of the basic important concepts that we need to be comfortable with when we are talking of the payoffs associated with the call and the put options, as well as forwards and futures for the long as well as the short positions. If there are any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.